Hi there, it's Azilia here from Tax World. Today I'd like to talk to you about Section 100 of the Taxes Consolidation Act 1997. Section 100 deals with a situation where land is sold and the seller retains a right for the land to be recoveyed back to him. When a property is sold with an agreement that the seller can repurchase it later, the difference between the selling price and the agreed buyback price is subject to tax. If the seller can repurchase the property 2 or more years after the sale, this difference is taxed as if it were a lease premium. If the buyback price can change depending on when the property is repurchased, the lowest possible buyback price is used for tax calculations. If it turns out that too much tax was paid because the actual buyback price was higher, the excess tax can be claimed back within 4 years. This tax rule also applies if the property is sold with an agreement that it will be leased back to the seller or someone related to the seller. The difference between the selling price and the combined value of the rent and the right to re-enter the property at the end of the lease is taxed as if it were a lease premium. For those in the business of buying and selling land, any amounts that are taxed under this rule should not be included when calculating their business profits for tax purposes. Additionally, the profit that is taxed as income under this rule is not also subject to capital gains tax. Let's look at an example. Let's say you sell a property for €200,000 and have the option to buy it back for €160,000 in 2 years, €170,000 in 3 years, or €180,000 in 4 years. Initially, the tax is calculated based on the lowest possible buyback price of €160,000. If you actually buy it back for €180,000 in 4 years, you can claim back some of the tax paid. I hope you found that useful, and I'll see you in the next video.